Well, good afternoon and welcome to Something to Chew On. Thanks for taking the time out of your lunch window or hour, if you will, to listen to some topics that I think are very important to us as women. My name is Sybil Slade, and I'm the founder and president of IntegraVest Wealth Advisors. I am your host for today's event, and I really curated this event solely for women because one of the things that I have been seeing as it relates to financial services and investments and women is that I am seeing more frequently now where women who are married are not as well off as they think they are as compared to women who are single. So I really wanted to have this conversation so that we as women, whether we're single or married, really truly understand the financial implications of our financial decisions, both short-term and long-term. One of the things that I do know for sure is at some point in our lives, we will be living off of one income if we don't do something differently. So that's whether if we decide to stay single our entire life, or if we become a widow at some point, or if we actually experience a great divorce. At some point, we will come down to a one income household. And it's up to us whether or not we have multiple income streams coming in to maintain the lifestyle that we currently have or that we desire in the future. One thing I know for sure, all of the situations that I mentioned a moment ago, if a male is faced with being a widower or if a male is faced with a great divorce, their life changes are impacted about 20 to 25%. But when it comes to us as females, that number increases. It's 47%. About 47% of our lifestyle will change. So that is why I think this is a very important conversation. And I want to make sure that I give you something to chew on as we go about our day-to-day financial decisions. And with that, I'm going to go ahead and share my screen and get started with the presentation. All right, so let's go ahead and dive in. Feel free to use the chat if you have questions or unmute yourselves. And if you're watching this on the replay, certainly you will have my contact information to refer to later. All right, let's get started here. So just so you know, this presentation is for educational purposes only, and it does not reflect the opinions of IntegraVest Wealth Advisors or Securities America and its affiliates. And the securities offered through Securities America, who is a member of FINRA, and SIPC, these advisory services through Securities America, Inc., IntegraVest Wealth Advisors, LLC, and Securities America are all separate entities. And Securities America, Inc. does not provide tax advice. So let's talk about challenges with women and investing. And so Fidelity Investors did a survey a year or so ago. Actually, it's about 2 years now. This survey is about 2 years old. And here are the things that they found about us as women. That we're 92% more eager to learn about financial planning. So we're really eager to learn about financial planning. But then about 80% of us confess that we have refrained from having financial conversations. And then about 60% of us worry about having money to last throughout retirement, which is certainly why I want to have that conversation today. And then only 47% are confident talking about money and investments with a professional. So I hope that I'm able to close the gap for those who are really reluctant about hiring or having a conversation with a financial professional. And then 74% of us are proactive about saving for the future. So in essence, we're definitely interested about saving for the future. We're really interested in learning about financial planning. We do worry about our financial future in retirement, and for good reasons, and you'll see why momentarily. But we're reluctant about having these conversations with financial professionals. Again, this is where I want to close the gap. So what this tells me is, although we hear all the language about, oh, women are conservative investors, that's why there's this wealth gap, the reality is we are actually financially curious, right? We know we need to do things and we want to understand things. I believe the reason why we're reluctant about speaking with others is, again, because I am in a male-dominated industry, and or maybe we are in a household where we're already reluctant to have a conversation with our spouse, so which makes it much more difficult for us to reach out on our own to other financial professionals. So I would like to close the communication gap, and I would love to close the trust gap. The reality is that we're really financially aware because we're interested in these topics and we have been saving. So now, how do we get started for investing for a lifetime? The reality is life gives us a lot of ebbs and flows. And so there are several stages in our lives that we need to invest in. We need to make sure that we're investing in our younger years because age, or should I say years or time is on our side. So the sooner we save or invest, the less we'll have to contribute towards our savings and investments on the back end. So we definitely want to make sure that we start early. We also want to build wealth. We know that there are some life cycle phases where we are going to take on debt. Maybe it's for home ownership, maybe it's for college education, things of that nature. And then there's going to become a point in time where we're going to want to preserve our assets and simultaneously still grow because we are living longer. So back to the years and time and age, statistically speaking, we're going to outlive our male counterparts, our partners, if in fact we do have a male counterpart, partner, or spouse. And so we need to invest and save for longevity. So we need to save and invest for the short game, the here and now, for the midterm aspects of our life, because we're going to have life changes that occur, and then for the tail end or the finale, if you will. So let's talk about some of these phases. So some of the challenges with women and investing in our early career is we really need to take a holistic approach to budgeting. And I personally subscribe to the 20-30-50 rule. So basically 50% of our income will take care of our expenses. And then we have 30% for our wants and 20% for our future. And so if we can really divide up our income as it comes in and make sure we hold true to those thresholds. So even when income increases, right, we want to make sure we're still living within 50% of our income, taking care of our needs versus experiencing lifestyle creep. So the sooner that we set up this type of budgeting approach, or whatever budgeting approach, there are so many out there, we need to remain consistent and stick to it. And again, I mentioned earlier, we want to save and invest early for retirement because, again, time is on our side. The earlier we invest and save, the less we'll have to invest and save on the back end to carry us through retirement, because we're going to take advantage of compounding and compounding interest. So that compounding over time is really what's going to give us the momentum that we need for our money. And then we need to understand retirement income needs. What will our retirement income needs be in the future? How much do we think we need to live off of in the future? So if we start thinking about those benchmarks now, then we're better able to participate in options that will help us to get there. Now let's talk about mid-career. So this is for the person who has really started saving in our workplace retirement plan, whether it's a 401k, and if you don't have one, you've started some type of retirement savings investment vehicle for yourself. And what I can tell you is most of the time when I'm having a conversation with a mid-career individual, the default answer is my husband is taking care of our retirement. And so this is where I would urge you to make sure that you are taking care of your retirement, because depending on the type of retirement plan that your spouse has, if it's a defined benefit plan or a defined contribution plan, then there may be some carve outs for you. But if not, and if it's where they can solely change who actually receives the benefits of the plan in the event of their death, you're not truly factored in that number. So your needs going forward in retirement are not necessarily factored in those numbers. So that is why we need to have these conversations. And we also need to do proper planning for ourselves in retirement. So take advantage of any workplace retirement plan that's available to you, and at least up to the match, right? So that's free money. If you're receiving a match for 3% or 5%, whatever that magic number is in your plan, make sure you're at least saving up to that, because if not, you're giving away free money. And then also you need to understand your financial position as a two-income household, right? So in your household, it's two incomes. What percentage of your income is taking care of the household needs? What percent of the income from your spouse or your partner is taking care of the two income household needs? And how is it, or can you possibly leverage your financial position for the two of you, where maybe perhaps you're living off of one income and you're saving and investing off of the other, so that again, you're creating momentum for the household. Then you need to understand your investment portfolio. Are you properly invested? Are you invested based off of your risk profile? What are you invested in? Does it match your goals, both long-term and short-term? And that's a very important conversation to have, because short-term, maybe you're looking to go back to school for an advanced degree, or maybe you're looking to purchase a mortgage in the future. Or maybe you have a child that's maybe entering college in a few years. So these are some of those short-term goals that you want to plan for, and what you're invested in and the time horizon on those things is very important, because you want cash to be available to you when that time comes for that specific goal. And then for your long-term goals, for retirement or other long-term goals that you may have, there may be something different that you're invested in your portfolio, so that over time, again, you're taking advantage of compounding interest, and the dollars will be available when you're ready for them in the future, and you're hedging against inflation, right? So your buying power continues to move along the continuum or the time horizon for you. And then you want to identify retirement income streams. You know, where will your retirement dollars come from? You want to make sure that you're very clear about what those streams are. Are they guaranteed? Are they tied to the performance in the market? What are those retirement income streams, and how are they positioned, and do they help to fulfill your goals? And then you want to establish a financial plan for retirement. A financial plan is basically a roadmap that's going to get you from now, the here and now, to retirement. And although you are committed to this plan, life changes happens. And so a financial plan will help you to see if you're on par or if there is something that's disrupting the plan, how can you plug and play something else to keep you on par? So financial planning through retirement is an essential part of our preparing for retirement. And so, again, as women, I hope that I am able to help you close that gap where you will reach out to a financial professional to help you build this roadmap, and you collaborate to ensure that all of your goals are being met both short term and long term. Now, let's talk about pre-retirement readiness. So this is for the women who are now you're starting to really take a close look at retirement. I mean, even to the point where you have started to picture it or envision it in your mind, and all the things that you want to do and accomplish and what you want your day-to-day life to look like in retirement. You have started to kind of play and toy with those ideas. So that's what I mean by the pre-retirement readiness person. So this person has already, again, determined some of your lifestyle expectations and your income needs for retirement. And so once you determine what that looks like, now you want to identify any income gaps between the income streams, because you want to really make sure that you have the right tools in place to provide the income streams that is needed to fulfill the goal of this picture or the expectations that you have in retirement. And then you want to preserve what you have. You have worked so hard to get to this space in place to begin envisioning retirement. You want to make sure that you can preserve everything that you have accumulated, right? And then you also want to create some guaranteed income for life. So if you don't have a pension plan that already does that, that comes from your employer, what other assets do you have or can you position to guarantee income streams in the future? Certainly Social Security, to the best of our knowledge, based on what your statement says to you today, that income will be guaranteed, meaning you know exactly how much you will receive from them in the future, unless, of course, some of the Social Security formulas or any of those things change through legislation sometime in the future. Elsewise, you pretty much know what income you're going to receive from retirement. So when I talk about guaranteed income streams, that means you know exactly how much you will receive each year from that particular income stream. And just know that if you use any other type of products to provide guaranteed income streams, that's going to be a little different from the pension plan and or Social Security. This is really going to be based on the claims paying ability of the issuing company. So if, for instance, you decide to do any type of annuities with these lifetime income riders, you want to ensure that the company that you're writing this product with or that you're purchasing this product from has the claims paying ability. So that means you're going to go an extra step, or the financial professional who's assisting you is going to go an extra step to make sure that this company is financially sound and all of those things. They'll check the ratings and just, make sure that you're very confident in that issuing company. And then, of course, there's a Social Security optimization strategy. So versus taking Social Security early when you're initially eligible, or taking it at your full retirement age versus delaying to 70, that will dictate how much return or you will receive for the period of time that you're holding off on your Social Security payment. And also, it will dictate what that looks like for the lifetime income stream of the Social Security payment. Now, once you hit retirement, then we get to the point where we're talking about tax efficient income distribution strategies. So now you have built everything up and you're ready to start taking distributions. One, you will start receiving a notice where you have to take mandatory distributions from your retirement plan if you have one. And so That's going to be one form of income. And then you'll have Social Security. And so depending on what those income streams equal on an annual basis, that is going to dictate what the tax situation looks like for those streams. So it's very important to think about how that retirement income is going to be taxed. And you work with a financial professional to make sure it's done in the most tax efficient way possible so that you're actually getting the momentum out of the retirement tools or vehicles that you have worked so hard to save up for. And then you're going to also think about long-term care. What does healthcare look like for you in the future? Do you already have pre-existing conditions? Are you fairly healthy? What does your family history look like? Those things that you may be predisposed to, or maybe there are signs of things that are already existing for you, or there's nothing at all. You're relatively happy there. I mean, healthy. There's still a number that you're going to spend out on healthcare and potentially long-term care. Again, we as women, we're living longer than men. And so we want to make sure that we have taken in consideration the cost of long-term care, and it's not necessarily been eaten up by these income streams that we spoke of a moment ago. And then legacy building. Again, we've worked so hard for these assets. We're trying to preserve our wealth, and maybe we have heirs that we want to leave things to, and we want to make sure that we're able to provide whatever that legacy is and in a tax efficient way. So in retirement, there's just a lot of considerations, again, where you really do want to work with a financial professional, because you want to make sure that you are achieving all your goals and in the most effective way or efficient way possible. Now, I talked earlier about there's this potential that we could be a surviving spouse if we're married, right? And so what happens if unfortunately, we become a surviving spouse, and when one spouse passes away, the tax bracket for the surviving spouse shrinks to a single taxpayer household, which means that the tax bracket is smaller, right? So now you're getting taxed at a higher percentage on a smaller dollar amount because your tax bracket is so much smaller. So your exemption window is smaller. You know, we get the tax exemption for a one-person household versus a two-person household. It looks totally different. So now we're essentially paying what's called a widow's tax penalty. And then, you know, the RMD may remain the same in some of our retirement assets due to the amount of assets left behind. Because what happens is if we inherit our spouse's assets, now that asset is a part of our retirement assets total now. And so when Uncle Sam says you're going to pay, you're going to have to take the RMD, which is basically a certain percentage that you have to take out of your retirement assets during retirement, regardless of whether or not you want to, regardless of whether or not you need it, because now Uncle Sam is essentially saying, I need you to pay taxes. I've given you this tax deferral for all these years, and now it's time for you to start paying taxes on those dollars. So now the amount of RMD that you have is larger. So from a percentage standpoint, the amount that you will have to withdraw is larger, which also means your tax liability is larger. So again, you're being taxed at a higher rate. So this is what I mean by the widow's tax penalty. So these are things that we're not considering if we're not really sitting down with a financial professional. And now the surviving spouse is also going to receive a decrease in Social Security benefits, right? Maybe you've been living off of two Social Security benefits, and now you're only going to live off the higher of the two. So that's a reduction in your Social Security benefits. And that means, Social Security income could drop anywhere between 33% to 50%, depending on both spouses and whether or not you both were previously receiving income. So that's a huge haircut, 33% to 50%. Essentially, Social Security was designed to replace 30% of your most recent year's earnings for higher wage earners who retire at 65. Now, if you were a lower wage earner, then it may replace your income at a higher percentage, even up to 37% of your income. 37% is basically the average amount that Social Security replaced of income for those who are retired or who were retired in 2022. So, is there a strategy to replace income when the Social Security income is lost? And so we have to start thinking about replacement strategies. So the timing of these retirement incomes, and then as they need to be replaced, do we have something in place to replace them? If not, then we have fewer dollars to live off of in the future. And these are things that we're not thinking about if we're not working with a financial professional. And then supplementing healthcare costs. That can be pretty expensive. Now, if you had a health savings account during your working years, or your spouse had one during his, and you never really depleted it, this can become an asset for you in retirement. But just bear in mind, with the health savings account, it can transfer to you, the spouse, without tax implications. But if any of those dollars are inherited by your heirs, such as your children, now they will actually receive a tax consequence because it will not transfer to them without taxes or tax-free. So again, this is another reason why we need to get with a financial professional who is looking at all of these aspects and the timing and the triggers for all of these income streams to make sure that you're receiving them tax efficiently. All right. Now, we also need to think about long-term care. Will there be any long-term care needs that we need to save for from a medical standpoint? But then there's also things as it relates to the remaining assets. So where will the single spouse live? Will the primary residence be sold? If so, the surviving spouse is going to receive a step up in basis. So basically what that means, if both of the spouses were a part of the residential property and one of them passed away, then versus it being 50-50 about the value of the home, but when the other spouse passes away, then whatever the value of the home is at the time of the death of the first spouse, then that is going to be what the new basis of the value of the house is. Basis meaning how much you have put into the house. And so typically you take the basis and you're going to subtract that from the value of the house at the time, and then that shows how much was received or earned or increase in value that the couple or the individual whose remaining spouse has received as a result of that. And in some cases, depending on the benchmarks of what that differential is or what the appreciation was, there may or may not be a tax consequence there. So again, these are just all strategies that a financial professional can help you with. And then depending on the state, sometimes you're in some of the assets, you're in a community property state versus a state where everything passes directly over to the spouse. So we have to be mindful of that. The appropriate beneficiaries on all of the assets, who is it, and how is the beneficiary designations placed on each asset? Are there children from previous marriages? Will the assets pass to the heirs tax efficiently? We talked about that a little earlier. And will there be a legacy to others after the second spouse passed? So what is your game plan for distributing assets throughout your life and from the grave? All right. So we definitely need to make sure that we're getting those estate planning documents together. Now, let's talk about the types of investment. I've said a lot and I keep referring to investment. So just so you understand a generic description of these, if you will. So stocks is pretty much owned by shareholders. So if you own a share of stock, you are a shareholder. So you own that stock. And so you either going to get returns or losses based on the amount of shares of stock that you earn. So these are a bit more riskier because literally you're going to feel the impact of the market, the up and the down movement of the market, because you're an owner, you're a shareholder. Now, when it gets to bonds, bonds is essentially this is a loan to a government entity. There can be corporate bonds too, but basically you have decided I'm going to loan this entity these dollars for a specified period of time. So that's whatever the term or the length of the bonds that you decided to engage with. This is how long you're loaning it to the entity. And when the bond becomes due or the term ends, the entity has promised to pay you back your money plus interest. So that's what bonds are. And then you have some bonds that, depending on if they're part of a governmental entity, there is no tax on what you earn, right, off of loaning that money to the entity. Then you have mutual funds. So mutual funds is really a pool of stocks and a pool of investors or shareholders in the stocks. So with that, what happens, you may have within the mutual fund, you may have a share of Coke, you may have a share of Home Depot, you may have a share of Delta. So all of those stocks are in there in that portfolio of the mutual fund. So that helps to hedge some of the ups and downs and ebbs and flows of the market. And then because there's a pool of investors, all of the risk is shared amongst all of the investors who are in that pool. And then certainly there are other types of investments, from insurance to annuities, there's alternative investments, real estate investment trust, a whole lot of other types of investment vehicles. And again, this is why it's very important to get with a financial professional to make sure that you're being placed in investments that match your goals and objectives, your time horizon, and your risk profile. Now, let's talk a little bit about fintech. I'm sure you've heard quite a bit as of late around fintech. This is a big buzzword. Everything's moving towards technology, and there are so many transactions that literally go across your phone every day. Financial transactions, about 70-something% of financial transactions, whether you're purchasing as a consumer or selling as a business owner, there's so many transactions that are going across technology, right, in this digital age. So there's something that's called fractional investing. And maybe you've seen some of these shops. I don't want to name any names because I don't want you to feel like I'm encouraging you to pick certain shops over others. But this is basically where you're purchasing a slice of a share of stock versus the entire share of stock, right? So for instance, if Amazon is $1,500 right now for one share of stock, but then you find a platform that will allow you in for $190, right? Well, that's because you're getting a fraction of the one share of Amazon. So there's a lower barrier to entry. You're able to do this from your mobile device. You do not have to trade on the open market. It can be bought from major brokers, but it's maybe difficult to resell, right? Because remember, you only bought a portion, a slice of the share of stock. But it's fine. I mean, so when I talked earlier about budgeting and you talk about your wants bucket, if you're fractional investing and you're my client, we're looking at that as a part of your wants bucket. This is just more of this hobby, learning type environment. It's not impacting your future. It's not impacting your main household needs. It's really just a part of your wants bucket. And so with these vehicles, you're learning how the money acts in the activities of the actual market. And it helps you to ask me better questions as your financial professional. So I'm not opposed to the fractional investing, but I do want my clients to understand what it is, the risk that's involved, and to really not focus on using their nest egg in that space. All right. Then there's cryptocurrency. Yes, we've been hearing this over and over, and digital currency. And basically, it's a digital currency in which transactions are verified and records are maintained by a decentralized system using cryptography. Cryptography. Sorry, that's a tongue twister for me. Rather than by a centralized authority. So meaning it's not going through our main banking financial system. It's bypassing it. So this is currently an unregulated space. So when my clients want to talk to me about cryptocurrency, the thing that I tell them, if you're going to Vegas today, how much would you spend in Vegas putting in the slot machine, feeding the slot machine? Well, this is the mindset I want you to have around this cryptocurrency space. It's not regulated and you're taking a risk. So be careful. Do not use your nest egg. Use your fund money if you're going to go into this space. So don't invest any more than you are willing to lose. And then there's robo-advising. And these are digital platforms where you get a lot of automated information. They may ask you a lot of questions, and then this algorithm comes up around things that you should consider based on your personal preferences or whatever your responses were to the question. But the thing about the robo-advising, while these algorithms are working in the background to present to you some options that are available to you, it doesn't really know truly about your personal situation. So it only knows the data that you shared. It doesn't know what economic climate you're living in, because there's a difference between living in Atlanta and living in Omaha. So it doesn't take into consideration all of these other subjective things that a financial professional will take into consideration. But the good thing about it is there's a low barrier to entry and low fees. So this is where you want to get started until you grow yourself up to the point of, now I have some assets that I really, really want a financial professional to take me forward. Then there's nothing wrong with starting with the robo-advising. Get started somewhere, but make sure you're on a platform that's trustworthy. Do your research when it comes to the robo-advising. And again, it's better suited for straightforward investing, but not for complex situations or situations that require financial planning. Everyone's favorite topic, right? Taxes. So there's 3 buckets when it comes to taxes. And this may or may not be your first time hearing this, but this is what I want you to consider. And this is a wonderful visual that was provided by Nationwide. There are 3 buckets for taxes that you should be thinking about, and they should be operating for you at all times, because when we get to distributing income in the future in retirement, they all come into play. And if for some reason you don't have one of these, it can really, really change your bottom line when it comes to your assets. So there's the tax me now bucket. That means anything that's coming in now, any type of income now, you're paying the taxes on it right now. So things like investments, they're generally taxed at income. Capital gains or dividends are tax rates. So if you have stocks shares of stock or any other investments that's not in a retirement or tax deferred account every year, this is when you would typically pay your capital gains taxes or your dividend taxes. And again, your income, like your earned income or income that you're bringing in throughout the year, you're paying that tax now, so you don't have to pay it anymore in the future. Then you have the tax me later bucket, which is essentially the tax bucket that where your taxes are deferred, very similar to your 401k plan or your health savings account, or if you have a flexible spending account, you're not paying taxes on that income right now. So these assets grow tax deferred, and taxes are paid when the money is withdrawn or distributed. So that it's paid later. So that's why it's called tax me later. Let it grow now and I'll pay the taxes later. Then you have the tax me no more bucket. And this is where you have things that will grow tax free. So things like insurance. If you have life insurance, remember I talked about life insurance can be an investment. If there's an investment component on the life insurance, and if you have been paying after tax dollars using your paycheck to pay this premium on the life insurance, then those are the things that can grow tax free in the future. Or maybe you have a Roth IRA account. So you're putting after tax dollars into this retirement account because it's after tax dollars. It has already been taxed because it was taxed over in the taxable bucket. And now it grows tax free going forward. So this bucket is unique because it again grows tax free, and money can be withdrawn on a tax free or tax preferred basis. So these three buckets, you can start filling them now so that on the back end, you really have three buckets to pull from based on your financial situation in retirement to ensure that you're doing everything tax efficiently. Let's talk a little bit about tax reduction strategies. So tax reduction strategies, these are strategies that include things like tax deferred investments. We talked about that a moment ago, or retirement plans that are tax deferred, or capital gains treatment. So if I have stocks and if I'm a day trader and I'm selling them every day, then within that year, all the capital gains that I may have made, then I am responsible for paying a tax liability on it. But if I decided that I am going to hold them more long term, then I'm going to be taxed at a lower, at a long-term holdings rate versus my personal income rate. So capital gains treatment is a way to reduce tax strategies. Again, we've talked about some tax-free investments like bonds, etc. There are some tax-deductible items that used to be we could, get a deduction for the mortgage interest on our homes until the standard deduction went up. So that kind of eliminate a lot of us being able to receive that. And then you have tax credits that are tax reduction strategies. Then you have tax savings opportunities. So tax savings opportunity is a little bit different from a tax reduction strategy. The tax reduction strategy, again, these are opportunities where you're able to reduce your tax liability through some sort of treatment, but it does not necessarily create a savings vehicle for you. So when we start talking about tax savings opportunities versus just reducing your tax liability, a tax savings opportunity is when we are utilizing some type of treatment that will reduce your tax liability by earmarking some dollars that becomes a tax savings for you, right? So for instance, I may have a SEP IRA because I'm a business owner and I have a tax liability of $11,000. But according to my bookkeeper and accountant, if I actually pay myself $3,000 in a SEP IRA, then I can save $3,000 on the $11,000 tax liability because I put it away to save for myself. And now I only owe Uncle Sam $8,000. So when I say tax savings opportunities, this is a treatment of your income or investment where you're reducing your tax liability because something is earmarked to create a tax savings for you. So it's not just reducing your bottom line when it comes to tax liability, because your tax liability is still the same number, but now you're able to retool some of this difference to you for a savings. Uncle Sam is allowing you to do this because you're putting it away for a goal for you that that they're going to allow you to redirect part of your tax liability towards yourself. And now you can just pay them the remainder. All right. So we have come to the end of this presentation. I hope you have found it to be useful. Again, I'm Sybil Slade, the president and founder of IntegraVest Wealth Advisors, and I'm here to help. If there are any questions that you may have, you can unmute yourselves at this time, or I can check the chat to see if any are there. If you're catching the replay, here's my contact information. And I can be reached at IntegraVestWealthAdvisors.com. If you decide you want to register for a free initial consultation, that is where you would do it. Just visit my website, book a meeting, and select free initial consultation, and we can continue the conversation there. And as you can see, the rest of my contact information is here, Sybil at IntegraVestWealthAdvisors.com. I thank you for your time and attention.